Good afternoon. Welcome to March, and welcome back to Cup of Joe, our monthly commodities update with a shot, our monthly coffee talk with a shot of commodities expertise. I got a little excited there. As always, I'm Mike Carrazzo, the content manager here at Ryerson. Thanks for joining us. We do this the first Thursday every month, and my man Nick Webb, director of risk management.
Did you do a little remodeling at your house? It looks like you got a new background.
Yeah, I just kind of moved to a new room. I was gonna actually just closing the shades on this one to so get a little different look this time.
Beautiful sunlit room. I love it.
Yeah, well, it's spring here in Chicago, at least for the next few days. We'll see how long that lasts. Nick, we have a special guest this month. I will let you introduce Jim, but before we get into that, just want to go over a little housekeeping. As I said, we do this the first Thursday of every month. Full episodes of this, if you don't catch it live, are then on our YouTube channel starting tomorrow. And you got a button there in the lower left corner, Q&A. Send your questions. We will try to answer those along the way. And if we can't get them along the way, we will certainly round up with them at the end. Now, I mentioned we have a guest. We have a few slated for the next few episodes. I'd like to point out in April, Elizabeth Efta, who is our director of logistics, will be joining us and talking a little bit about that, because I got a feeling it might be something there. Lots changed since our last talk, right, Nick?
That's right. Absolutely.
Yep. So yeah, without further ado, kick it over to you, Nick, and get it going.
Perfect. I'll go ahead and hop into my screen real quick. As we always do, got to go through the safe harbor provision. These are the opinions of Nick Webb, Mike Carrazzo, Jim Reed. They are not the opinions of Ryerson. This is not investment advice. We recommend you do your own research, but we're going to do our best to get you the information that's live and in front of us right now within the commodities world. And with that said, I'm going to kick it over to Jim Reed. Jim is he's our director of risk management for the West Coast of Ryerson. So that's basically going to be the Colorado Rockies West. I would say his particular expertise is going to be most poignantly within the aluminum space and the stainless world. And today we're going to have Jim as our expertise covering the stainless markets, because there's a lot going on there as well as some of the other markets. But Jim, welcome.
Yeah, thanks for having me. It's great. First of all, the director of supply chain for the West, definitely not a risk manager.
Oh, apologies. Apologies. I was getting a little selfish on that.
I also cover Mexico too, for those of you that have some questions for the Mexican market. We definitely can get into those. So let's first look at the mill outlook right now for 2022. Who's on allocation? Who's not on allocation? What is going on? We'll start up in Ohio with Cleveland-Cliffs, better known as AK Steel, for those of you in the past. They are very specialized grades and gauges, and they are on allocation. There's no spot tons available unless you have a contract with Cleveland-Cliffs. If we come down to Pennsylvania with Allegheny, they are producing no vanilla grades of stainless like 304 or 316, right? They're basically producing specialty grades and plate mill plate, so large plate products. And there is no allocation currently out of Allegheny. If we keep on coming down, if we go to Oticampo in Alabama, they are a big supplier of cold roll product. They are very much allocated. So anything cold roll like 2B, BA, number 4, we are still very much in allocation with that, with Oticampo. CMP for them is not as much allocated. We can get some CMP product from them, and it is available. If we talk about Oticampo's sister company down in Mexico, in St. Luis Potosí, they are definitely allocated. No product or spot is available from them unless you have a contract with Mexinox down in Mexico, Oticampo. North American Stainless in Kentucky, they are very much allocated. Again, all the cold roll, like number 4, 2B, BA, 2D, it's all very much allocated, and as well as bar products. Anything coming out of NAS with bar products is definitely on allocation. Again, CMP product as well as plate mill product or discrete plate is more readily available, not on allocation. And there are some angles coming out of North American Stainless that are also not currently allocated. We can get some tons of angles should anybody need them.
Hey, Jim, a couple quick questions for you. One would be, obviously it looks like nearly every stainless mill within at least America, maybe North America, is on allocation right now. When we talk about that term allocation, it sounds pretty limited in terms of what's available. Are there any buffers up or down if somebody has a contract with Ryerson or another supplier? Do the stainless mills allow for any flex on that if your forecast exceeds or if your actual demand exceeds your forecast?
Sure, great question. And normally the bill of materials that we deal with both with the mills, they give us a percent, 5%, 10% plus or minus, right? But normally we're hitting right at the allocation. If for example, if we go over the allocated tons that the mills have given us, they come back to us and tell us to rebalance our books. They are only taking so many tons. So we're very careful with that. Absolutely.
Like 1 in, 1 out at the club.
Yep, exactly.
Excellent. The other question I had was, as we look at the map here, basically all the stainless mills are going to be east of Texas. You cover the West Coast. Does that make your market more import dynamic, or is a lot of this stainless traveling a long ways?
Currently, with all the current issues with, say, Section 232, with the port issue, with the congestion at the ports, a lot of our stainless does travel from east to west for sure. Is the West Coast an import market? Absolutely it is. And we do participate in the import market also, albeit currently lead times are extended. And you'll see lead times right now are into July arrival for the West Coast. And that's if we get it to the port and able to get it unloaded, right? But there is definitely an import market on the West, and we do use that. We do participate, absolutely.
Perfect.
Overall demand is still pretty strong. So far, we've seen 2 price increase announcements year to date, and this is only March. Last year, for comparison, out of the 12 months, we received price increases 9 of those 12 months. So strap in, buckle up. Things have just started so far for the stainless mills. As I mentioned, offshore is available. Right now, X mill June, July arrival, July, August, depending on where it's coming into the US. All ports of entry are still very much congested. For example, I was on a call earlier, and there was a vessel that arrived in the end of December in the port of Los Angeles. It's not even at berth yet. We're waiting for it. We have another couple of weeks. Luckily for me, it's not stainless, but it is for one of my accounts out here on the West Coast that deals with carbon. So it's been a challenge, right? Again, ferritic and austenitic co-roll, like number 4, 2B, 2D, still very much allocated across the board, right? CMP, definitely not as tight. There are some depots. The mills are starting to put some depot stock in, albeit rather small, but they are putting some depot stock in. All grades polished are very tight. The polishing lines at the domestic mills are backed up a lot, matter of fact, as well as the outside processors. If we want to send 2B coils and send them to get polished, they're running anywhere between 4 and 6 weeks to get things polished. So all things polished are still very, very tight. Again, I'll just touch base again. CMP, plate mill plate or discrete plate and angle are available. None of those are being allocated currently. So we do have some flexibility for that. Absolutely.
Hey, Jim, question.
Sure.
Yeah, question for you on the polish side. So in terms of that market being as tight as it is, in your opinion, is that more a function of a certain end market being exceptionally strong on the demand side, or do you think that's more a function of just us being limited on capacity for polishing equipment?
I think it's a combination of both, quite frankly. We know some of the end markets definitely have picked up the need to polish, like the appliance market, if you will, right? As well as polishing seems to always be a problem at the mills, right? As far as the process it has to go through. So I think it's a combination of both. Absolutely. Yeah.
Jim, on the allocation side question here, is that vary on grade? In other words, is like 200 and 400 series more difficult to get than say 300?
See, now we're really getting into the details. That is a great question because yes, it is. We actually have certain buckets per mill, per grade, per thickness of gauge. So it's very much allocated by grades as well as gauges and widths. So yes, it is. And that's what we do at Ryerson. We have to balance that book so it all comes out right. So we get everything that we need. Yep.
And kind of maybe kind of step back and kind of a basic question. When something's on allocation, how long does it usually take to get back, right? Like, what does that mean long term? Like, how long do you typically have to wait?
Yeah, before we get back to our normal supply without having allocation, that's a great question. It would be nice, and I'm not saying this, it would be nice if the second half loosened up a little bit, right, for allocation, so add a little bit more flexibility. But I am telling you right now, it's not anticipated to loosen up for the second half. Talking to the mills, they're still anticipating it to be tight for the second half for sure. We can tell you as far as on the bar products that North American Stainless supplies, there'll be no let up at all on allocation for the balance of the year. And as far as the flat roll from both Outokumpu as well as NAS, we're not expecting any loosening of the allocation for the balance of 2022.
Amazing.
And Jim, this question just came in. Forgive me if you covered it, but are offshore markets also on allocation?
Not as much so. Some of the Asian markets are very busy themselves with demand. They did expect a little bit more increase after the Chinese New Year than after the Olympics, right, in China. So there are some. There is more allocation. We're limited on the amount of tons coming in because there's only certain mills that can come into the U.S. for sure, right? We don't receive any Chinese co-roll into the U.S. because of dumping duties that were put in place back in 15 or 16, and that now with Section 232, the other mills like South Korea has a quota, Taiwan we pay the duty. So there is, but it's not as tight, if you will. Like I received an offshore offer yesterday, so we're going to look at the offshore offer and probably make a buy.
And then here it comes. Here's a question from the audience. Is the price all related to nickel increases and the Russia-Ukraine crisis?
No, I'd have to say it's not. It definitely, the increasing that we're seeing now are related to some of the nickel pricing, but you're seeing that in the surcharges, right? As well as the other components of the surcharges, will it be silicon, whatever it be. But this is just overall energy, overall labor, just the ability for the mills to keep up and the overall demand. So it's definitely not all related to the Ukraine-Russian situation. We were in this situation before this happened a couple of weeks ago. We were in the same situation.
Jim, the Cup of Joe audience doesn't waste any time getting to the tough questions. I apologize for that.
Okay, hit me.
Well, one in particular is any mills increasing capacity or adding a new mill on the stainless side.
I've heard nothing domestically other than there's going to be a new line put into one of the domestic bar mills for shot blasting, but nothing for flat roll as far as I can tell. Nothing that I've heard to this point.
And I will piggyback on Jim's answer there. I actually have a slide at the very end of this presentation that will cover not domestic, but some of the foreign production increases that will be coming or expected to come.
And there's a few other here waiting in the queue, but I got a feeling, Nick, you're going to cover these in some of your slides coming up too.
Okay, perfect. What I would say is, Jim, if you don't mind, sit tight. I'll run through sort of the macro environment, and then I'll run through a lot of the commodity elements. And then on the back end of this, obviously it'll be a full-on onslaught of Q&A, hopefully. And anything mill related, anything stainless related or aluminum, I'll probably dish some Jim's way. And then all others, maybe Mike and I can handle. Before I hop into the macro, I do want to acknowledge one thing, which is I am not a geopolitical expert. Obviously, we have to talk about the Russia-Ukraine situation to some capacity, but I don't want to pretend to be an expert in this field. I also don't really want to talk about the minute-to-minute headlines that may move markets one way or the other. But what I do want to do is we have to acknowledge it because it is moving markets. It's moving markets in both directions, and the path to which we go over the coming weeks and maybe months will likely have an impact on metals markets, commodity markets. So we have to address them. But in terms of specifics around what we think is going to happen with Russia and Ukraine, I kind of want to leave that one to be, because if you flip on your TV right now, every TV station is covering it at length. So you can get your coverage from there. But with that said, I'm going to move this over here so you can see this. We've looked at this chart in the past. This is going to be the purchasing managers indexes for all around the globe. And you can see it's alphabetical order, top to bottom. Left to right is going to be March of 2021 through February of 2022. And not too much has changed. I think as we look left to right, you can see a ton of green still. And when you look at things like the Eurozone, you look at the United States, both very strong from a manufacturing standpoint. So again, this is survey data done by purchasing managers in the industrial space. So from a European standpoint, North American standpoint, I think the market looks quite strong. And actually, we just got our latest data point for the PMI for February just a couple days ago, and it actually ticked up a little bit. So not only is it strengthening on a year-over-year basis, the pace of that strength is actually improving, which is a pretty positive sign for this stage in 2022. I will note, however, there are a couple other regions that maybe have flipped from going green to maybe yellow, or maybe just going a little softer. And one that I'd obviously point out is going to be the emerging markets. I think over the last couple months, as inflation has started to rear its ugly head, and maybe it has for the last several months, but it's really starting to pick up. And the first place you'd see inflation bite is going to be within the emerging market sector. And you can see that about 6 or 7 down. Worth noting, China's still kind of tepid in terms of its growth. It is in the positive territory, being above 50, but it's not by much. So it's really mostly sideways for the last several months within China. We'll talk about that in a little more detail. But I do think it's worth noting that there are a couple regions. Obviously, Russia has moved into negative territory to a small degree. I think if we fast forward another month or two, I hate to say it, but we'll probably see that negative go much deeper. And if I had to guess, it's going to go deep into red territory because of a number of factors we'll probably talk about here in a few slides. Flipping over to China, we talked about how up to this point, their manufacturing activity has been relatively tepid, but we've talked about this chart in the past, which is the Chinese credit impulse chart. This is looking at how much lending or how easy credit conditions are within the country. And when you can see that over the last decade, basically, there have been peaks and valleys that kind of mimic one another. And it looks like we're beginning to trough out and head the other direction if history repeats itself with regards to Chinese lending conditions. Just about a week or two ago, China did announce that they were going to cut mortgage rates to try and spur their housing economy. So we are beginning to see some of those early signs as we get beyond the Chinese New Year and we get beyond the Olympics. Are we going to begin to see a lot of pollution and a lot of manufacturing uptick? We'll have to see here in the coming weeks, but it looks like the early stages are somewhat optimistic for them to kind of rejuvenate their economy. There's a lot going on here in this slide. This is a new one, but this is ultimately going to be looking at the the Russia-Ukraine situation. The left-hand chart here is going to be 3 indices. We've got the Bloomberg Commodities Metals Subindex, the Energy Subindex, and the Agricultural Subindex. So the white line is going to be metals. So that's going to be a basket of all base metals, ferrous metals, precious metals. The blue line is going to be your your energy complex, which is going to be crude oil, natural gas, coal. And then the orange line is agricultural basket. You can see that I've kind of cherry picked the data going back to April of last year, but in all 3 of these markets, we are in very inflationary markets, and we're also in, for the most part, very tight supply-demand conditions, where even prior to the Russia-Ukraine situation, a lot of these markets were getting pretty tight, and prices were elevating up near record highs, and in some cases, actual record high prices. Fast forward to where we are today, this is where we have to address the elephant in the room. Russia and Ukraine do represent very sizable players within the natural resource space. Over on the right-hand side, the top right-hand side, I've got the Russian market share. So in the center column here, we've got the Russian market share of each of these individual commodities. And it varies by commodity, but Ultimately, when you look over on the far right-hand side, you can see what percentage of their market share they actually export out into the world economy. So you look at things like crude oil, they're 10% of the world market. They export almost half of that. So you're talking 5% of the world crude oil market that could get sanctioned, blocked off, blocked from purchasing, however you want to phrase these sanctions, whether they're federally backed or whether it's just private organizations, halting purchases or activity with them. This is the magnitude of what we could possibly expect. So we start working through some of these metals. Aluminum, 6% of the world share, 80% of it gets exported. They aren't consuming a lot of their domestic aluminum industry. So that would be a big hit if it gets cut off. Copper, similar thing, 4% of the world share, 75% of that gets exported. Nickel, even bigger, 8% of the world share, 90% of that market gets exported. So this is why we're seeing such volatility and such big gyrations in the price of a lot of these metals and energy products and food products, because they are big in all of these. You work your way down into this bottom commentary. Russia and Ukraine combined are 14% of the global wheat market. So, there is a lot of, I'm not at all trying to give Putin credit in this situation, but if ever there was a landscape over the last decade where there was leverage to take action on something like this, we're in it right now, because as we saw over the last week and a half, when the invasion began, both Europe and the United States were very cautious and very slow, and potentially maybe even weak in issuing widespread sanctions. And I think one of the main reasons for that, I don't even think it's any big secret at this stage, is that the food security and maybe more drastically the energy security of Europe relies on these supplies. So until or unless there's a backup or a contingency plan, some of these markets that were already tight could get a whole lot tighter. And I think, when we take our prior Cup of Joes into context, we've talked about things like the revenge of the old economy. And we even had a Kanye West reference. We talked about, the shortage of all things. And that was all before the Russia-Ukraine situation. If anything, if this persists, this is just going to make everything that much more heightened, that much more risky, that much more volatile, and likely to the upside for now. This is a chart. This is actually a new one, but I'll give a quick lesson on futures markets, and I'll use a little bit of context with the steel market. What this is looking at is it's called contango or backwardation in the futures market. So what this chart is doing is it's looking at the spot price of a basket of commodities. So it's looking at the front month futures contract, and it's comparing it to the same commodity 1 year out in the future and seeing whether the price is higher or whether the price is lower. If the spot price of a commodity is lower than the futures price, we call that contango. It's a fancy finance term. It just means the current price is lower than the later price. Right now, we're in the exact opposite scenario, which is called backwardation. And that occurs when, in essence, you have kind of a panic buying type situation. If you'll recall, for those of you who have joined us on the Cup of Joes in prior months, the steel market, when we looked at the steel futures curves, was very much so in a backwardated environment for about 12 to 18 months. That was a situation whereby we kind of had panic buying. There were backlogs of orders, and it was essentially name your price. Well, unfortunately, that phenomenon is now spreading into an entirely broad basket of commodities. And again, so you can see it across the entire basket. On average, across the Bloomberg Commodities Index, the backwardation is roughly 12 to 15%, which means that on average, there's a shortage of a lot of commodities. And there's a premium that you have to pay in order to get the commodity right now versus several months into the future from now. So I apologize if that was a little wordy. I went a little quick through my explanation, but ultimately what this chart is signaling is that there is a lot of panic buying. There is a lot of scrambling of trying to find contingency plans, backup resources, backup supply chains. And that's really, it's at record high levels as we sit here today. We've talked about this in the past, but this is a slightly different set of indices that we'll reference. We talk about the revenge of fossil fuels. This chart here is actually looking at two different types of coal. So what we've got here is thermal coal, which is the coal to heat your home, heat your facility. in the white line. And then you've got the blue line, which is going to be metallurgical coal. So that's the coal to actually manufacture things like aluminum, things like carbon steel. And this is a 5-year chart. And you can see in both instances, they've gone straight up. And I mean, we've seen a lot of pretty crazy charts. This one may take the cake, that as we have the Russia-Ukraine situation playing out, and there's a real risk of energy shortages, well, you kind of have to go to whatever energy source is next in line. And right now, that's some of the old school fossil fuels. So you can see the price of a lot of these have doubled, if not tripled, just in the last couple of days, let alone weeks and months. So as we think about what this means, and we're obviously seeing it within crude oil, we're seeing this similar phenomenon within natural gas in Europe. All of this is likely going to spill through to higher cost of producing things, higher cost of finished products as it works its way through the supply chain. So this is a little bit of a forward-looking statement. This is Nick Webb's opinion, but if I was a betting man, I mean, I think the subsequent next couple of months, we're going to see not reduced inflation. I think as this works its way through the economy, I think we're going to see pretty rapid rates of expansion in a lot of the inflation data points. So hopefully it's temporary. We will see how it plays out, but this is a pretty wild phenomenon, what's happening within the energy space.
Nick, real quick, in previous, you talked a lot about China focusing on possibly reducing their CO2 emissions. Do we know, are they still focused there, or was that more transitive?
I mean, I say it's a little tongue in cheek. I would say short answer is no, they aren't. I mean, they didn't attend the climate summit. Not that that's the end all be all of whether or not you're a good citizen or not, but I think it was 2 weeks ago, they announced a $4 billion investment in coal. So it does look like they are getting very much back to their old roots of using the cheapest energy sources possible to produce their products. So no, I wouldn't say that they're on the same trajectory that maybe Europe is attempting to be and the United States is attempting to be. But I will also say at this point in time, we might be in such a scenario on a global basis where maybe all the world ends up being a bit of a bigger polluter because some of those cleaner sources like natural gas may not be available if and when larger sanctions occur with Russia, Ukraine. We'll have to see how that plays out.
And there's a question that followed up on this from the audience, and specifically this impacts aluminum mills, right? So do you know, has there been any talk about opening up more capacity for aluminum mills?
Yeah, I'll talk specifically about the production capacity at the very end, but yeah, with regards to energy sourcing, it absolutely impacts not just aluminum mills, but really all the metals producers, probably most on the aluminum side, just because it's more energy intensive than many of the other metals. But it's impacting aluminum in a couple specific ways. One is obviously coal, natural gas, crude oil prices going higher makes it more expensive to smelt aluminum. But also, with a lot of these companies sort of publicly saying we don't want to do business with Russia right now, or maybe for the foreseeable future, there are a number of aluminum mills over the last couple of days who have stepped up and said, we're not going to buy alumina, we're not going to buy aluminum from the country. And that, similar to what I was saying before, they're going to have to find contingency plans of where they're going to source those raw ingredients. Otherwise, they have to shut down. And those are all of those things are on the table at the moment, I would say. And admittedly, in the last 30 to 45 days, there have been a couple curtailments due to increased energy prices. So yeah, all of these things, we could cover this for probably another couple hours because they are all so interrelated in terms of how energy impacts metal, how metal impacts inflation, and the whole circle of all of it. But it is all interrelated for sure. And with that, I mean, keeping those coal charts in mind and then looking here at the price of nickel, I mean, we were already on a pretty drastic uprise in the price of nickel, and all of a sudden we jumped about $3 to $4 in just a couple weeks. And no surprise, it is heavily linked to the tensions that are going on within Russia and Ukraine. As I showed in that previous table, Russia does represent a very sizable portion of both the global market as well as the export market of nickel. And when you have rising demand of stainless steel and of electric vehicles in the face of potentially sanctioned or blocked off nickel units, we're starting to see what I'll call scarcity pricing in a lot of these markets where there's true panic buying. I mean, we see charts like this, and I normally would take a step back and say something like that shouldn't last. Just visually, it doesn't look like it's natural. But those are the types of phenomenon that take place when you have real scared buyers. So that's kind of why I call it scarcity pricing. So yeah, for now, the market looks pretty well supported. If tensions cool down, yeah, I would say all things being equal, we'd probably expect a bit of a reversion back lower. Maybe we pull back down to some of these moving average lines, which would be, more of a normal bullish gauge. Right now, we're in pretty unprecedented air, but we're not anywhere near record highs just yet within nickel. Back in 2005, 2006, prices got up to about 23, 24 bucks per pound, but certainly relative to the last decade, we're at very elevated levels. Part of the reason why, in addition to the Russia-Ukraine tensions, is that we are seeing dwindling inventories on the London Metal Exchange. This is the exchange inventory levels, 77,000 tons basically. It is leaning out. There's no doubt about it. And I would say the market is prepped for new supply because we have both strong stainless steel demand and we've got the burgeoning electric vehicle market that's taking up a larger and larger market share every single year. So yeah, until or unless new supply meets the market, and I think we should expect to see some come later in the year, but a lot of that's been delayed due to COVID lockdowns, things like that. But the markets, even without the Russia-Ukraine situation, are relatively tight. We've talked about this in the past, but this looks at how money managers are positioned. If the chart is below zero, it's indicative of being bearish or short the market. For above zero, it's a bullish positioning for money managers. And you can see we're pretty much near the multi-year highs. And no secret, if the markets are seeing everything we're talking about right now, traders are likely going to be positioned on the long side for now. This can unwind very quickly if tensions ease, but for now, money managers are positioned pretty bullishly. Switching over to the carbon side of things, a little bit different story, actually a lot different story. We've got the white line showing the United States price of steel, which is really going the opposite direction of what aluminum and what stainless or nickel have been doing. Prices have come down by about half. And you can see that when we look at foreign prices, both on a European and on a Chinese basis, that gap between foreign and domestic has pretty much closed. And for that reason, and that reason alone, I would say it really doesn't make a ton of sense to continue buying carbon sheet imports at this stage, because there just really isn't a financial argument until or unless markets get truly tight again and you just have to go offshore to get that next incremental ton. I don't think we're quite yet in that environment, but that should set up a little bit of I'll call it a soft slide from here, or probably a more gentle decline from this point forward, and maybe even a little bit of stabilization, because if foreign markets are on par with where domestic markets are, there really isn't much of an incentive for domestic mills to drop their price too much further. We did obviously see the CRU drop pretty drastically this week by about $95 per the hot roll contract. But again, we're getting down into territory where the gap between domestic and foreign is pretty much closed. The other factor that's beginning to play a role, which really hasn't played a role for the last 2 years, is cost push. In other words, the cost of scrap to produce steel, carbon steel. The price of scrap has actually risen per the futures contracts shown down here in the yellow line by about 100 to 150 bucks just in the last week. Some of that is centered around the Russia-Ukraine situation, the belief that less scrap and less carbon units are going to be out in the world. Part of that, I think, is due to the fact that some of the slowness out of the automotive industry is creating a weakened supply of scrap. But nonetheless, that scrap support, when you take scrap and you add on, let's say 250 to 275, which is what I've done here in this chart, that basically gives you your implied cost of production for a steel mill. When you take scrap plus 275, that kind of gives you an idea of potentially where the floor might be given what we know today. Because if we start dipping below those types of price levels, the steel mills are just going to say, okay, we'll shut in production because we're not making as much money as we want to. So that to me kind of tells me the trough may be coming in the not too distant future if we're using cost as a proxy, which I think is a pretty decent one. It is a proxy that we have not been able to use for the last 18 months because prices just got so far out of whack from the cost structure. But it's beginning to play a role a little bit here. And I think that's one of the reasons why we saw two things take place in the last 2 weeks. One is Cliffs Natural Resources announced that they were closing blast furnace number 4 out of Indiana Harbor. So that's going to take some capacity offline, and that's going to be permanent. And then the second thing that's taken place is a couple of mills have actually announced price hikes. And I think this all kind of centers around this notion that margins were beginning to contract at the steel mill level. They're believing that they have some ground to stand on, that markets are beginning to tighten up a little bit. And whether they're trying to stop the bleeding or whether they actually think markets should be higher, I don't know. I won't necessarily give my opinion here, but I will say it seems like the decline or the rate of decline is beginning to slow pretty drastically.
Hey, Nick, quick question. If carbon base price coming down and scrap increasing, is that more of is that typical? Is that typical event, or is it something unique going on right now?
No, I would say usually the relationship is almost 1 for 1. We've actually done some historical work on this, and the correlation between scrap and steel is historically about 90%. So there's usually, with a 1 month lag, there's usually a very good relationship between scrap pricing and steel pricing. And it generally makes sense because you're using one to make the other. So there should be a relationship between the two. No, I would say that relationship of one going up, one going down isn't all that common. So I think that's going to change most likely. That we'll get back to the normal positive correlation between the two. And with that said, so here's the futures curve data that we always look at. Again, the blue line is going to be 6 months ago. There's a backwardated market for you. That's a great example of that backwardated market. We look at a month ago in the green line, which again, still a backwardated market, which is kind of a situation that's suggesting the market was still tight. We're now in a scenario whereby we're actually seeing a slight contango or upward slope in the futures market. Now, part of that may be due to this idea that markets are looser and the cost to get metal now is easier than it will be a couple months from now. I think the other phenomenon is with the price increases being announced by Cliffs and a couple others, there is an expectation among some market participants that we're beginning to find a bottom and prices will be moving higher in the subsequent months. We'll see. I mean, if you paint a scenario whereby automotive production begins to ramp back up, some of these supply chains loosen up, demand for carbon could pick up. And I think that, a lot of cities around the world are beginning to lift restrictions for COVID. And I think demand has a lot of room, particularly on the manufacturing side, to pick up. Those sorts of scenarios would probably be supportive of a positive move in carbon prices. But right now, the market's actually pretty positive, suggesting that steel prices for hot roll will be a little over $1,000 for the balance of the year and basically into the foreseeable future. So with that, we'll end it on the aluminum side where we probably have the most to talk about. But just like the nickel chart, it almost looks identical in terms of it was in a bullish trend to begin with, very much so, had an upward momentum coming out of the COVID lockdowns. The last couple of weeks, we've seen that go parabolic, almost straight up. It's almost crazy to say because right back here in 2018, this would have been when the United States enacted sanctions on Russia. It's amazing to see how small this blip is in comparison to what we've seen over the last several months. It's the same country producing the same aluminum, but I think just given the fact that we were coming into this with so much liquidity printed by the governments, two, tight supply demand conditions, tight supply chain bottlenecks. You factor all those things together, I think we've just created a more intense storm for aluminum, and you can just see it visually in the charts in terms of these gaps higher and how volatile these moves have become. Again, I think that if tensions were to subside, I look at this chart and it really does suggest that conditions are pretty overbought right now. There's a lot of panicking going on in the aluminum market right now. Some of that is very rightfully so because there are shortages. There's a lot of scrambling to try and find that material in a fairly strong global manufacturing environment. But again, like I said, it looks pretty darn overbought right here. Doesn't mean it can't go higher, but it's a very interesting space at the moment. Flipping over to a chart we haven't looked at in a while, but this is alumina. So this is going to be the raw kind of dirt that goes into the production of aluminum. And again, referencing those 2018 prices back when we had sanctions, this would have been when there were actual real sanctions placed on Russian product and on Rusal specifically. At that point in time, we saw immense volatility and actually even more volatility in the raw ingredient than we're seeing right now. I don't know for sure whether or not we're going to see these types of price moves here in the coming weeks and months, but it certainly looks like it at least rhymes with what happened back in 2018. Maybe you can make the argument that we're not quite seeing the volatility now because there haven't been formalized federal sanctions on Rusal just yet. So there's a little bit of a gray area where some people maybe are still playing in that market, playing in that space. But we'll have to see how that plays out in the coming days, because there's always a potential that additional sanctions specifically on aluminum could come. My personal take is I think there's probably going to be an attempt to avoid sanctioning anything commodity specific for two reasons. One is obviously if you're sanctioning commodity related markets in an already bullish scenario, you're going to drive inflation significantly higher. I think the other factor is if you sanction, and this is my personal opinion again, if you sanction commodities on one hand, it may be a tit for tat where they come back and they say, okay, well, we're not going to ship natural gas out of the country anymore. So it's a very dangerous game that I don't think we want to be playing too often until we have to. Looking at the exchange inventories, similar story to nickel. They are certainly lean. They're on the leaner levels we've seen in the last several years. There's no doubt about it. The market is still tight with regards to raw ingot units of aluminum. So that's also playing a role. And then, on the positioning side for money managers, we're at very bullish levels, about the highest levels in the last several years. I don't know if this means anything, but there's a very slight downtick in the money manager positioning just in the last couple of days. Perhaps that's a situation whereby there might be a little bit of profit taking. We did, and we are at record high prices for aluminum. So when you take LME aluminum, you tack on Midwest premiums, which I'll show here in a second, very easily at record high prices for the cost of aluminum ingot. This is that chart that I was referencing. This is the chart of Midwest premiums. So again, to review, this is the premium to get aluminum ingot into the Midwestern portion of the United States. There are a couple factors at work here. One is the trucking issues that are happening both within Canada and within the United States. And it kind of looks like some of these convoy situations are beginning to rear their head a little bit here within the US. Those are causing real logistical issues for getting aluminum around the country. That's being portrayed here within this chart. We are now at record high prices for Midwest premiums as well. The other factor that's being priced in here, which is why we're seeing this move higher just in the last couple of days, is there is a real risk that US government or European governments may place tariffs on Russian material. Again, my personal take is I don't think that sparking that inflation flame is something that administrations really want to do, but it is absolutely a possibility. And I think that risk is being priced in as we sit here today. So that's the commodity world. That's kind of the bad news of everything. The little bit I wanted to end on this slide because it is a little bit of a silver lining on everything potentially. Both within aluminum and within nickel, there are expectations. I know there are a lot of words on here. I'll summarize them quickly for you, but there is an expectation that over the course of 2022, production is expected to ramp up. I want to be careful how I say this, that additional supply, if it were to occur, would help to act as a headwind on the price of commodities. So if a lot of these markets are in panic mode, we're in this scarcity pricing scenario in both aluminum and nickel, these production ramp ups would help to better supply those markets. I don't think there's any secret about saying any of that. I would say that both of them are probably a little delayed in terms of their ramp up due to lockdowns, logistical issues, things like that. But you look at, in the case of aluminum, about 500,000 tons of additional aluminum capacity is expected to come online over the course of this year. And then down on the bottom table on the nickel side, the predominant supply growth is coming by way of Tsingshan, which is the world's largest stainless steel producer. And I saw just last night, they announced that they were beginning to ship nickel matte units out of the country. That's going to be out of Indonesia. So those sorts of things should help to maybe act as a headwind a little bit. I'm not necessarily saying that's going to bring prices down, but it should better supply a market that very much so needs additional capacity to come online. And you can see the other miners that are expected to bring on capacity perhaps later this year. So, there could be a scenario whereby, things are very, very tight and panicky right now. Maybe clear heads prevail with regards to the geopolitical tensions. Maybe clear heads prevail with regards to production increases, and we see things ease back from a price standpoint later in the year. I think that would be a very welcome surprise for many of our customers that are on this call here today. But with that, that was a mouthful. But I apologize if that was a little fast, but there is a ton to talk through, and these, I would say more so than the last decade, commodities are at the very forefront of most economic discussions these days. So this is pretty important stuff. I think it's going to ripple through the economy to end users at some point, and it's going to be something that all of us want to be aware of. But you guys are hearing it first on the Cup of Joe.
So great stuff, Nick, Jim. I took notes here. So commodities that probably have a big impact from what's going on with Russia and Ukraine. I got zinc, manganese, iron ore, nickel, right? What else should we keep a close eye on?
Yeah, honestly, I would probably just come back to this table here. Certainly crude oil, natural gas. Natural gas is likely the big one for Europe. That's the one that's causing a lot of strife with that continent. Aluminum is a big one because it's almost 80% exported. So you're talking 4 to 5% of the world market share that could be blocked off. Nickel is a very big one. You're talking 8% of market share, 90% is exported. So call that 6 to 7% of exported demand. Platinum, palladium are big because, they're 27%, 11%. That's got to be a big one that the automotive industry is watching, because you think about catalytic converters, that would be real impactful if that supply was blocked off. That'd be just one more thing in addition to the semiconductors and all those issues. And then, thermal coal. Thermal coal is admittedly, we may not be using as much of it here within North America or Europe, but there's no doubt. third world countries, smaller countries, less developed countries are still absolutely utilizing coal for power because it tends to be cheaper. It pollutes, but it's historically been cheaper up to this point. So yeah, those are the big ones. And then admittedly down to the very bottom, I'd be remiss if I didn't touch on the agricultural space, because 29% of wheat exports is a pretty big number. And God forbid we head into a situation where, because of the tensions, a new crop of wheat and corn doesn't get planted and we all of a sudden have food shortages. It's a possibility as we roll into the spring months. So I would say all those things are factors we want to keep an eye on.
Yeah, it kind of speaks to the trend you've been doing. The kind of the underlying theme for Cup of Joe since we started, right, is the shortage of everything, and I think this has an impact right down to the crops that are being planted for sure. So, as always, we when you go through the carbon market, we get our question here about plate. So gaps still historically high between HRC scrap and kind of the divergence between plate, because I know you say plate typically lags by 6 weeks.
I'd say roughly 2 months.
Okay.
Gotcha. I don't know if that's a forward-looking statement to say because it lags, we expect it to follow the same path. But if we assume the general relationship between hot roll and plate follows again, we would expect plate to likely go the way of hot roll, which is lower in the coming months. But again, I think we are beginning to see some stabilization in carbon prices. We've gotten wind of a couple different headlines and obviously the price hikes from the mills that suggest that prices are not only beginning to stabilize, but maybe even there's some optimism coming back into pricing for carbon markets. We'll have to see how that plays out, because like I said, the CRU just this week dropped pretty substantially. So, that might be because it's a lag index, but nonetheless, I think we probably need to wait another week or two before we call the turning point or anything like that.
Here's a question for both of you, specifically to some end markets. What's going on with, pull it up here in the chat, my apologies, is automotive demand expected to be weakened throughout 2022? And I would imagine that speaks also to the EV market and kind of what's going on with the battery demand there. So you guys maybe speak to that.
Yeah, I'll take a quick stab and I'll dish it over to Jim. I would say from an overall manufacturing demand standpoint, I think that could probably be summarized pretty well from the PMI data, which I know this is an eye test, but down here near the bottom, a PMI of 57.3, which is the latest data point. That looks pretty darn good to me. That's not to say the world's perfect or the economy is perfect. I think there are real risks, and I think inflation probably is becoming an issue. I mean, if it's not already hurting pocketbooks, I think it may be coming potentially. Again, I'm not trying to speak too much on my opinions of where the market goes, but I think in terms of manufacturing demand and volumes we expect to see shipped, I think it's looking pretty positive for sure for the first half. Now, yeah, if we end up seeing, and I do think this is a possibility, there are a number of analysts who corroborate this. If we end up seeing $150 to $200 crude oil, which isn't really off the table, that could start to cause some issues. And then you potentially have a situation where inflation runs so hot that it either breaks economies or central banks are forced to hike rates so fast that it ends up causing a mini recession or a recession. We're not in that stance at this stage. So as I sit here today, I look at most end markets pretty positively. Automotive is maybe the one that's artificially weak at the moment, mainly due to supply chain issues. But I think if those things can alleviate themselves, which knock on wood, we've been saying that for about 9 months now, then I think that would be just one more feather in the cap for the manufacturing economy.
I have to second what Nick is saying on automotive. If automotive picks up, because it's kind of soft right now, if it picks up, it definitely could affect the aluminum market for sure and the availability. There's no question.
And I guess staying on the industries, the question from me is, a lot of our listeners are involved in the energy market, of course, everything what's going on with energy. What kind of impact would that have on, supplying to the energy sector, I guess, and all that going on?
Yeah, it's a tricky one. I mean, I think we specifically look at the oil patch and you think about crude oil prices being $110 a barrel here in the US, 115 in Europe. You got natural gas, I think $4.50 today, roughly. Those are pretty elevated prices that historically would have suggested boom times for the economy, boom times for Texas and that whole region. I think it's a little bit of a different regime this time around. And again, I need to be careful about how I say this, but certainly with the push towards renewable energy, I think there's less excitement from the traditional fossil fuel players to immediately take all the profits they're making and reinvest that, because I don't think certain groups of people really want that to be the case, so that they want there to be a shift of investment more towards renewables than into traditional fossil fuels. So historically, this would have been a boom time for steel and for metals demand and things like that. I still think it will be. It may just evolve in terms of the pie and the market share as to where those things go. It may not go into line pipe and things like that. It may go more into wind towers and other sources of energy like that. That being said, I mean, my personal take is I think, at least for the immediate term, it's becoming pretty evident that energy security, food security is a pretty important thing. And I think to ensure that is going to be one of the more important themes of this year and maybe for a couple of years. So I would think that all things being equal, it should be more metal going into the energy space as a whole.
I have nothing to add to that, Mike. Really, I agree with that for sure.
Okay, Jim, this one's for you. Back to on one of your slides, you talked about the price increases. Right, here we are in March. We've already experienced 2. We had 9 last year. What's typical when you compare?
Geez, that's a great question. Back pre-COVID, I mean, it would be, we might see 2 a year, maybe 3 a year. Right? So these numbers, it's unprecedented. It's just crazy.
Right. Gotcha. Yep. Another question here is, now, Nick, I apologize if you did speak to this during the carbon futures slide, but has there been a particular jump in carbon futures in the past few days?
Yeah, there has been. I think part of that is going to be back on the back of the mill price hike announcements, the curtailment of Indiana Harbor blast furnace number 4, which is a Cliffs facility. I think those two factors certainly add a little bit of optimism into the market. The jump was pretty drastic, though. So this again will be a little bit of an education lesson. The steel futures market is not quite like buying and selling Apple stock. You can't just trade millions of dollars of it in a second. It tends to be a little less liquid. So because of that, there are fewer players and it can gap around a little bit. So I think there's a small bit of that going on within the futures market, that maybe a big buyer stepped in and bought a large piece of steel futures over the next 12 months, let's say. And just due to general illiquidity or lack of participants in that space, it may have caused a bigger jump than it otherwise would in a different market. That's just my personal take, but yeah, there was about a $250 move higher in just a matter of, I'd say, 3 or 4 days. So pretty drastic.
Got it. Another one about specifically a market. Do you have any insight, kind of where do you see the Class 8 truck market going?
Yeah, I think I can talk about this. This question was actually asked on our earnings call, and we do participate in the Class 8 space quite a bit. And I guess our general commentary, not trying to deviate too far from what our management has said, is that we're expecting the Class 8 forecasts and Class 8 market in general to be pretty strong, build rates to be very strong this year. So I think those ranges are even, easy double-digit type growth rates. So I think that market, it looks pretty darn strong for 2022.
Got it. Now we're running up against it here. I guess I'd like to give a minute to or so to each of you to kind of give some closing thoughts here. On there's a lot of information like you shared here, like you said, and of course, if we don't get to your question, we will definitely try to follow up with you on that. But just some little housekeeping here. Again, full recording will be available tomorrow on our YouTube channel. We're going to talk a little bit about freight logistics next month. Jim Reed, thank you for joining us and getting into stainless. So with that, I'd like to leave it to Jim and Nick, each of you with kind of a closing thought. Jim, to you first.
Well, thank you both for having me. It's been my pleasure. It's always great to get out and talk to you guys like this. This is a challenging time for all of us, but we're all going to make it through to the end for sure. 2021 was a challenge. We all know 2020 was a challenge, right? But 2022 is going well. It just continued to communicate to your Ryerson folks, and we should be able to meet all your needs and demands on the stainless side.
Yeah, I'm going to double down on that just because, we talked a lot about scarcity of things and scarcity in pricing. And I think I don't want to scare everybody into panicking and clearing out the shelves of everything. Stay close with your salespeople. And if you feel like you've got concerns about availability of something, keep us in the loop, keep the sales teams in the loop, and that'll ultimately work its way through Jim and a lot of our procurement specialists. We believe we're in a really good position to keep everybody supplied, keep everybody's facilities running. I'm pretty confident that's, even in this environment, going to be the case. There is a lot of craziness out in the market, but I think when we look specifically in the metals that we're supplying you or can supply you, I think we're positioned well to help out in this environment. But these markets are moving on a dime, and anything that's more tension oriented is probably going to be bullish for commodities, and vice versa is likely also going to be the case. So it can change in an instant, which is mainly the reason why I didn't want to make any predictions on how all of that plays out. But we hope everybody stays safe, and we look forward to giving updates on how this plays out here in the coming weeks and months in subsequent Cup of Joes.
And I should add Kanye West's last episode, contango, is a word I learned this month. I learned something new from you every month, Nick. So
appreciate that, Mike. Hey, thank you, everybody.
thank everyone.
Thank you.